Let's take a look at Nvidia's stock. After the earnings report, we experienced a very significant rise. I'll show you the support levels, we'll touch on volatility, the volatility smile, and the market forecast. As usual, I'll also show you a strategy where you can make money regardless of whether the stock rises or falls. To begin with, Nvidia stock has experienced significant movements following earnings reports. As we can see, in May 2023, Nvidia experienced a substantial rise. The catalyst was the earnings report, followed by consolidation. Then the next earnings report sparked a new wave of growth. After the February 2024 earnings report, we saw another 3-month consolidation. And now a new earnings report has been released, and is this a new wave of growth? After the report, the stock rose by 20%, which is quite significant, considering its market value of $2.85 trillion. In fact, the company is almost becoming the #1 on the stock market. It's very close to surpassing Microsoft. Honestly, its earnings are not comparable to companies like Microsoft and Apple, but the market is obviously pricing in incredible growth, which is understandable. I have already analyzed the earnings report in detail in this video, where I explained everything comprehensively. The report turned out to be good, no doubt about it. Additionally, we are expecting a 10-to-1 stock split, which is also driving the stock up. The question is, where might it stop? Volatility and trading volumes will give us the answer. Let's look at volatility. As we can see, volatility was very high before the report, which is a normal situation. After the report, volatility dropped to 40%, and for some options it went down to 30%, which is normal. Currently, volatility is starting to rise again, naturally due to the stock's movement. Let's also take a look at the volatility smile. We can see that volatility for the near-term expirations is rising both for increases and decreases in the stock price. This is a normal situation, as traders are hedging against both potential upward and downward movements. Now let's look at historical and implied volatility. At the moment, historical volatility is represented by the gray line, while implied volatility is shown by the white line. As we can see, there is a slight divergence in volatility at the moment, especially at the far end of the curve. This divergence at the tail end of the volatility curve is actually a very important indicator that many people underestimate, because volatility always tends to revert to its historical values. Trading stocks is actually very challenging because nobody knows for sure where they will go, but trading volatility is much easier. Volatility will return to its historical values, and I'll show you how you can capitalize on this. Artificial intelligence can help us create a strategy to understand how this works. Let's say we predict that volatility will increase by 20%. The AI will automatically generate interesting strategies for us. For example, we could buy a put option with a strike price of $1,550 expiring in August, and sell a put option with a strike price of $1,550 expiring in September. This strategy is complex because it involves different expiration dates, and it requires active management. I'm not recommending you open this position, I'm just showing how you can play on the reversion of volatility to its historical values. Now let's look at the most important indicator. I love the options trading volume. We can see a significant resistance level at $1,200. This is a critical level, and Nvidia might reach this price. However, I'm not planning to buy Nvidia stock at this moment, and I'll explain why later. This first resistance level also has a level at $1,150. We've already reached this level and bounced back. Today's trading, which still has about an hour and a half to go, clearly showed this bounce off the $1,150 level. We must never ignore these levels. As always, I emphasize that you should pay attention to them. Additionally, we have a smaller level at $1,100, which has also been overcome. Therefore, it is likely that we will overcome the $1,150 level and move towards the $1,200 level. For put options, we also have levels at $1,100 and lower. Everyone is betting on growth, which is somewhat concerning. Why are these levels important? Let me try to explain briefly. When investors and traders buy call options, the other side is typically market makers who sell these call options. When market makers sell call options, they are exposed to unlimited risk and potential loss. To mitigate this risk, they need to buy shares according to delta. This is known as delta neutral hedging. The higher the stock price goes, the higher the delta, which means more shares need to be bought. This creates a feedback loop where market makers drive the stock price higher. Therefore, breaking through this level is undesirable for market makers, because if the level is broken, they are forced to buy more shares, potentially driving the stock price even higher, possibly up to $1,300 or $1,500. However, we must consider that these levels mostly align with May 31st. After the expiration, new levels will form, and this period can be opportune to catch the market when old levels expire and new ones have not yet formed. But this requires very skillful execution. Now, returning to the main point, my philosophy is that I do not know how to predict price movements. I am honest about it, I don't know where the stock will go. I focus on observing derivatives data. The question is how to make money. I always say that you can earn through proper portfolio management. That means structuring positions and the portfolio in such a way that you profit regardless of market direction. I have started a new portfolio from scratch, and you can watch the video about it. I also rely on mathematical expectations and probability theory. At the moment, in my opinion, based on probability theory, buying these shares is not the best idea. To sum up, the importance of these levels lies in the market makers need to hedge their positions. The more the stock price rises, the more shares they need to buy to remain delta neutral, potentially creating a feedback loop. As these levels coincide with option expirations, significant price movements can occur. Proper portfolio management and understanding the market dynamics can help navigate and profit from these situations. Because yes, I assume that the stock could rise to $1,200. I am saying that the stock can grow, but the profit potential here is extremely low. The risk to reward ratio is not in your favor. I have a certain strategy that I follow, and even if I see that the stock might go up based on some technical parameters, I won't open a position if the risk to reward ratio is not in my favor. That is the most important thing for me. Nothing else matters, just the risk to reward ratio. Now let me explain what I mean. First, let's look at the 3D volatility. Here we have all the information concentrated about expiration dates and strike prices. This information helps us to create sound strategies. So let's take a look at the strategy I've developed. It looks like this, as we can see. This strategy allows us to profit regardless of the stock's direction. If the stock rises to $1,350, we will earn $18,000. If the stock drops to $950, we will earn $16,000. Yes, there is a risk of a very sharp rise or a very sharp decline. We cannot exclude this possibility, but this strategy requires active management. But as we can see, we have a profit everywhere with a probability of 77%. The strategy looks like this, but again, we have sold options here. We have unlimited risk, so this strategy needs to be managed. That means at some point selling options, at another point, buying options. Closing a position, sometimes maybe closing at a loss, but then restructuring the position. So it needs to be managed, and only through management can you make money on it. I showed this not so that you would follow this signal, because it is indeed very risky and suitable for professionals, but so that you understand how I form a portfolio. Again, the risk to reward ratio is not favorable for investors. At the moment, simply buying this stock, in my opinion, is very, very risky. Now, let's look at what the market is forecasting. Yes, I predict one thing, but what does the market say? As we can see, the market is pricing the stock at around $1,150, $1,110 by mid-August. This range has the highest probability, so the market predicts that the stock will be slightly lower than it is now. If we look at the end of 2024, the market suggests that the stock will be below $1,000. Again, the market is anticipating a decline in this stock. I wouldn't advise betting against the market. Yes, I understand it's gratifying when your stock is rising, but this won't continue indefinitely. I assume that sooner or later this will end, and the stock could very well drop significantly to $500 or even lower in the event of a recession. If such a scenario occurs, the stock might fall. Once the hype around artificial intelligence subsides, this stock could stay below its historical highs for decades, similar to Tesla. Tesla had a peak in popularity with electric vehicles, and everyone thought they would take over the world. However, for almost 3 years now, Tesla's stock hasn't been able to surpass its maximum. I assume the same will happen with Nvidia, just with different competitors entering the market. The topic will become less popular and relevant. However, it's undeniable that Nvidia is a very powerful company. This can't be ignored. So we will continue to monitor this stock. In the future, I will definitely show the next support levels. Also, I remind you about my experiment in creating a new portfolio from scratch. You can watch this video. I guarantee that I share a lot of insights there, and I will show you how I form a portfolio with complete transparency. Good luck to everyone.